Welcome to Meridian's full year profit announcement for the year to June 2018. I'm Neil Barclay, CEO of Meridian, and with me I have Paul Chambers, our CFO. I'll cover off some of the highlights of the year and how we're seeing the environments in which we operate. Then I'll hand over to Paul to drill down into some of the business and financial performance in a bit more detail. This snapshot coming up shows plenty of outcomes we're very pleased about, and we'll talk about most of these in the presentation. Firstly, we've delivered Meridian's highest ever EBITDAF number of $666 million, and you can see that our CFO does have a bit of an evil sense of humour. I'm dying to see the headlines in the analyst reports tomorrow, but the important thing there is it's quite a turnaround from the first half when we did report a 7% result down on the previous year. I think it is a quality result, given that we did have to manage the effects of two reasonably significant dry periods. And our generation production was also the lowest we've had since 2013. So an important enabler of that is that in New Zealand, the hedge market's been maturing quite dramatically. And we've seen more than 1,000 megawatts of thermal generation retired since 2012. Yet the market for financial risk management and products is more liquid than ever. Also, our strategy to diversify our business with a focus on retail and overseas growth has shown signs of delivering. We achieved a 5% lift in customer numbers and a 4% lift in overall volume sold. The growth was spread across PowerShop and Meridian brands and across all of our segments. Our customer teams have done a great job, in my opinion, not only chasing new customers but also improving our relative retention rates. And really pleasing is the improvement in the brand metrics that we're seeing. We believe PowerShop has the best NPS, that's Net Promoter Score, in the industry, and we know Meridian easily leads the top 5. One other highlight that doesn't spring out straight away from the numbers is that our generation and maintenance crews completed what we believe was the biggest year of work in our history. This wasn't because a whole lot of things went unexpectedly wrong. It was because we're getting better and more efficient at getting through our scheduled maintenance plan. We have a 20-year maintenance program, and that gets translated into several hundred operational projects in any year, and we managed to complete those well this last year. And lastly, we were very pleased to complete the 50 megawatt baseload electricity contract with NZAS, and that will enable them to enliven their fourth potline. It was a complex deal that involved many counterparties, but it will see NZAS increase production probably this October. Excuse me. The fact that NZAS are choosing to invest in increasing production at the Tiwai Point smelter is obviously a good sign for the longevity of that facility. It all starts with our people, and our employee engagement is high. We use a Culture Amp survey tool, and whilst 78% was a strong number for the year, we were aiming at the top 10% globally. So we've got a bit of work to do. To help us to make the step, we've sharpened up on our set of core values and behaviours that we believe in Meridian. And we'll continue with our unrelenting commitment to the safety and wellbeing of our people. I think probably the aspect I'm most proud about coming out of the engagement survey is that at Meridian, 97% of our people strongly believe that the organisation and their manager cares about their safety. This last year, we've also commenced a mental health initiative that was available to all staff and their families, and that's to ensure that general wellbeing receives the same sort of level of focus as physical safety. Another sign of good engagement is that half of our New Zealand staff elect to give up their salary each year to be Meridian shareholders through our employee share ownership scheme. Voluntary parental leave increases and rainbow tick accreditation are initiatives designed to lift cultural and gender diversity and pay parity where it needs to be. So these are all the sorts of things that we're doing to ensure that we have that really strongly engaged staff team. Now, just on the topic of pay, there seems to be some confusion about executive remuneration at Meridian. Well, Owen tells me there is, so it is pretty conventional. We have a fixed remuneration, which is base salary and matched KiwiSaver contributions up to 4%. We have an at-risk short-term incentive based on company profit and individual objectives. And we have an at-risk long-term incentive which is equity-based and on a 3-year relative TSR. And you can see from the chart that we have delivered double-digit TSR over a number of years, and we've matched or bettered the peer group through that period. So that's been reflected in exec pay. Our perspective on sustainability is that long-term success will come from managing risks across environmental and social issues and being effective in the social purpose we need to fulfil. Along with being a responsible generator and all that entails in New Zealand, we have identified 2 other areas of focus in line with 2 of the UN Sustainable Development Goals. That's SG 13, Climate Action, and SDG 7, Affordable Clean Energy. There's a growing momentum behind New Zealand's climate action and decarbonisation aspirations. I think it's fantastic that as a country we're stepping up to this challenge because, frankly, everything else pales in comparison. I'll talk more about the macro opportunity that could offer to the electricity sector a bit later, but right now we are focusing on putting a lot of resource and effort into promoting and supporting EV adoption in New Zealand. Our taking on Norway TV ads resonated very well. Our EV tariffs are highly competitive, and we're working on developing the most comprehensive charging infrastructure packages available in the market. As an aside, and it is early days, but we've noted that off-peak charging incentives offered to customers on our EV plans seem to be having the desired effect, so that's a really strong win-win if that continues. We're also pushing into the commercial solar market, where we think the economics of solar work best in New Zealand at present. We've recently sold what will be New Zealand's largest solar installation to an Auckland customer, and we are contracted with another customer, Kiwi Property, for a further 4 solar installations, which we will own, but we'll have a PPA back to Kiwi Property as part of the arrangement. The sales hopper for large-scale solar opportunities is increasing at a rapid rate. I think you're getting the sense, but we are an organisation that truly does think about everything we do through a sustainable lens. It's really as part of the DNA of the organisation. So whilst we can be pleased that we've reduced our direct carbon emissions per person by 17% in the last 5 years, we consider that we need to do more. So as of 1 July, we are committing to be net zero carbon across all Scope 1 and Scope 2 emissions. And this year we're also commencing a mostly native tree planting program, mostly on our own land, to ensure that the company will become net zero carbon for all emissions, including Scope 3 by 2025. In terms of the affordability of energy, the reality is some New Zealanders really struggle to afford to keep their homes warm in winter. We're very aware of this. We put a lot of emphasis on developing our customer hardship program, and as a result, we have some of the lowest disconnection rates in the industry. We'll continue to develop how we support customers. For example, we're looking at removing the conditional aspects of the prompt payment discount to ensure our most vulnerable customers get their discounts. But it's important to acknowledge that the reasons some customers struggle to pay their power bills are complex and include factors like income levels, quality of housing and appliances, cost of other household goods. So from our perspective, sound energy sector behaviours and policies cannot necessarily fix many of those social issues. Our markets. In the next few slides, I'll cover off some of the key development trends in the different markets that we operate. We did note modest demand growth in the last year of around 0.8%. It looks likely that continued positive macro factors are driving this, despite overall warmer average conditions or temperatures. Looking forward, and in the context of the government's zero carbon by 2050 aspirations, it's fair to say most views of demand growth are becoming more bullish. Certainly, if we are to achieve zero carbon by 2050, then renewable electricity must play a huge role of that in the New Zealand environment. But I would say that whilst long-term future looks bright for new renewable electricity, we're not expecting to see any dramatic change from current trends in the medium term, and I'm talking, say, to the middle of next decade. That said, it is possible 1 or 2 large-scale new renewable projects will be built within the next 4 or 5 years, and that most probably will be wind. From 2025 onwards, the picture looks very interesting, and given the ageing nature of much of New Zealand's remaining thermal generation, we think the prospects look strong. In terms of supply in New Zealand, despite some very dry times in the South Island, persistently above average North Island storage meant renewable generation was still above 80% participation for the full year. The modest demand growth expectations in the short term are probably reflected in benign forward prices over the next 3-year ASX curve. But as I say, things may get interesting beyond, say, the middle of next decade, depending on your view of increased electrification and plant retirements. New capacity to the equivalent of 2 or more mid-sized wind farms could be needed to meet year-on-year demand over the long term. So one of the interesting challenges, I think, in New Zealand that we have to overcome is how the industry can get all of these potential new renewable projects consented. As you can see from the bottom chart on the graph, many existing consents expire by 2026. In fact, the bulk of them do. Now, we aren't going to need the 9,000 gigawatt hours of additional generation by then, so most existing consents are going to have to be extended and in many cases modified as technology has improved from when they were originally consented. To give you an example, one of Meridian's wind options was consented for turbines with an 82-metre diameter, but the more efficient new machines on the same site, we could put 150-metre diameter machines, and as you can imagine, the economics get a lot better with the bigger machines. So whilst all this consenting activity is maybe doable, it is time-consuming and it's very expensive. And I think if we're genuine about New Zealand achieving a zero carbon by 2050, then and I think we absolutely need to be, we do need more pro-renewables policy support as part of the RMA framework than we have today. Sort of in the same vein, the big challenge for New Zealand and its aspiration to be zero carbon by 2050 is clearly agriculture. You can see from the slide, it's responsible for over half the country's emissions, and it pushes our per capita emissions rate up to one of the highest in the world. But I'll leave that for others to solve. The good news from our perspective is that most of New Zealand's remaining emissions come from the energy sector, mostly road transport and stationary energy. These emissions are solvable, directly or indirectly, through electrification and largely through renewables. But we'd need to be smart about it, and chasing 100% renewable electricity grid, even in a normal hydrology year, may not be the smartest way to go about it. Electricity generation itself isn't a large source of emissions, only about 5%, because of our existing high renewable participation rate. We think it is inevitable that renewable participation will increase, perhaps as high as 95% over time, and that will occur naturally and efficiently, largely enabled by our country's super flexible hydro backbone. But hydro inflows can be quite volatile, and we have relatively low hydro storage. If we remove all the thermal storage from the system, it could cause significant cost and/or reliability issues, which would obviously be counterproductive to converting the broader energy sector to electric. Just to give you an idea of the costs and complications involved, if we were to eliminate all thermal storage and still maintain a reliable grid at a reasonable cost, well, it might not be at a reasonable cost, it would require another 1 or 2 Lake Pukakis. Now, Lake Pukaki is New Zealand's largest hydro lake. It stores about 50% of our hydro storage. Has an operating range of 17 metres from top to the bottom, and it's not that clear to me where we'd squeeze another 2 of those into the country. Or we'd require 280 million Tesla Powerwall batteries at a cool $4 trillion. Now, batteries are obviously not going to be part of the deep storage solution for New Zealand, although they will play a part in terms of managing peak capacity and ultimately transmission distribution costs. I personally think coal must be phased out of the system. It's a climate killer, but gas as a hydro-firming fuel probably needs to be part of the system for the foreseeable future. And to me, that's okay, as it will help facilitate the electrification of the broader energy sector and much lower emissions overall. In summary, New Zealand needs to protect and, where possible, augment the hydro storage we already have, and we need to set a renewable energy target as opposed to a 100% renewable electricity grid target as the best way to facilitate New Zealand's shift to a low emissions future. Continuing on the policy angle, we believe that overall the New Zealand electricity market is highly competitive and is delivering fair, efficient, reliable and sustainable outcomes for customers. The World Energy Council ranks the New Zealand electricity system 9th out of 130-odd countries, and I believe we're about to move up one slot on that chart. And we're the only non-European country in the top 10. It's also worth noting that New Zealand electricity prices are 40% lower than our closest neighbour, obviously Australia, and 55% of New Zealand customers considered switching service provider last year, while 35% actually did. I think these are signs of a highly competitive and efficient market. But we do expect the electricity pricing review, which is currently on, who are expected to produce an issues paper by mid-September, will identify some opportunities for improvement. It's well documented that price increases over the last decade have mostly come from the non-competitive parts of the market, and we believe distribution pricing reform is needed to ensure that those who are least likely to be able to afford the new technologies that will enable them to reduce their consumption in the future don't end up funding an unfair share of the transmission and distribution costs going forward. It's also well understood that the low user fixed charge regime is poorly conceived and produces perverse outcomes. I doubt there's any argument that change is needed to get in front of those potential issues. But we also expect the review will suggest, in line with similar studies in the UK and Australia, that disengaged customers tend to pay more than customers who switch providers regularly. We are working on suggestions that we will put to the review panel to make pricing more transparent and to encourage stronger engagement from all customers. But given my opening comments on the topic, we shouldn't slavishly follow what has been proposed in Australia and UK, in my opinion, as the conditions in the respective markets are quite different. We get a strong sense from the review panel that they are seeking to consult heavily on the issues paper, and we look forward to engaging with them in that process. Transmission pricing reform. We remain in a wait-and-see situation. The delays to this process are disappointing, but we remain supportive of the central theme of beneficiary pays. And we think the Electricity Authority's recent comments on application being to all future and maybe some past major investments seems a pragmatic way to go forward. So we remain hopeful of a sensible outcome in 2019. In the meantime, the status quo projections look like a future cost reduction to Meridian from lower WACC in the next regulatory period and an end to the historic recovery of underpayments in respect to the HVDC. Australia, I'm sure you all read the papers, so I'm not going to harp on too much about the turmoil that's going on over there at the moment. Let's just say that they're struggling to find the right policy mix to support decarbonising the electricity sector to meet their Paris commitments or targets. It's interesting, though, that despite this, we've seen 10 coal-fired stations closing since 2012 and more expected to close between now and 2035 for engineering reasons alone. But arguably, this hasn't been well managed, and customer prices and system reliability have suffered as a result. The political and regulatory uncertainty has seen a significant lift in the volatility of wholesale market and a significant lift in retail prices. The attached comparison with New Zealand residential prices gives you an idea of the quantum and the change that Australian consumers have had to put up with over recent times. Accordingly, over the last year, we've adopted a hold position in PowerShop until we could develop a more cost-effective hedge strategy. We've done that now through the acquisition of the Green State assets and some 10-year power purchase agreements. Given we now have a stronger wholesale position and we've delivered gas retailing into the PowerShop customer proposition in Australia, that business is set for renewed customer growth in the coming year. It is interesting, though, that the political uncertainty is not necessarily slowing development of new renewables, and certainly the PPA market is very strong at present. Two of the PPAs we signed earlier this year, being Salt Creek and Crudine Ridge wind farms, are both tracking well and are expected to deliver first power in line with expectations. We also signed a PPA with the Kaiamel solar farm, and that development failed to reach financial close by the agreed date, and we have exited that arrangement. Despite the uncertainty, Australia is a destination for cheap overseas capital, and that offers positives in the form of further PPA opportunities, but also challenges from lower returns required by foreign-owned retailers. Alinta, Tango, Glowbird are example of these. The UK, Paul will touch on retail dynamics that we're seeing in the UK market in a bit more detail. However, it's clear electricity pricing has become very politicised as well. Government intervention into the electricity market regulation seems likely to end in legislated price controls. And the problem with a regulated price cap, and you might see it in Australia as well, is if it is set too low, it will most likely drive competition and innovation out of the market. So they can actually be value destroying for consumers, let alone the industry. While the UK has seen historical residential prices increases at higher levels than New Zealand, current prices are similar and both compare favourably with OECD comparisons. So I think just a couple of summary points in the last two slides. I think political and regulatory volatility in these markets can be opportunistic for small retailers like Powershop. We understand the risks, and to date we've managed them very well. Australia and the UK are also often used as comparators for the New Zealand market, and in New Zealand, the average residential electricity prices stack up well against those markets. Capital management. We've been talking now for about 10 or 15 minutes, and this is probably the bit you wanted to hear about. Predictably, I think the board has decided to continue with our existing capital management program for a further unimputed dividend of 2.4 cents per share will be paid with the final ordinary dividend in October. The existing $625 million program will run through to February 2020. So I expect there's more interest in the new capital management program that we've announced today. We made a commitment to the market late last year that we would provide an update on capital management during 2018, and so we are indicating a new 2-year program starting in August 2020. The new program will be subject to the same caveats as the existing program. That is, it'll be subject to regular board review, including return mechanisms and structural risk or changes in the industry. For example, if NZAS were to announce an exit, then you could expect the program would most likely be suspended. By putting forward this new program, we're aiming to achieve a competitive future dividend yield while allowing flexibility for us to consider investment opportunities and maintaining our credit metrics at sensible levels and reflective of our relative hydrology risk. Beyond 2022, we see a sufficiently positive outlook for value accretive growth opportunities in both New Zealand and Australia, and accordingly we want to maintain sufficient balance sheet flexibility to ensure Meridian can participate appropriately in market growth. This reflects the positive future demand outlook outlined earlier and possible asset retirements, providing the need for new renewable generation in New Zealand. Our customer growth projections in Australia also suggest Meridian Australia will require further wholesale or generation support around that timeframe. And lastly, it also takes us through to 4 years from now, and we think we are casting forward a reasonable level of shareholder return continuity and certainty given that period of time. There is no change to the current ordinary dividend policy. I'll now hand over to Paul, who can talk to the numbers in a bit more detail.
Thanks, Neil. Neil's given you a good flavour of the environment we're currently operating in and some of the challenges and opportunities that creates for us. I'm going to spend the next few minutes just looking at the detailed financial performance and overall performance of our different business areas, and then move on to just the numbers. So this year we've made further use of the extra potential given to us by the back-to-back contracts that cover part of the smelter load, and we saw some of the strongest customer growth in the market over the second half of the year and ended the year up nearly 14,000 customers over last June. This brought volume increases in all segments except residential, where the back-end nature of the growth and its North Island weighting had an impact on average usage per customer. We did see a $1.59 decline in average price in the mass market segments, with volume weighted more heavily to business and agri customers and competition remaining fierce across all channels. The corporate segment has also seen an intensification of competition. I think you've seen that in others' results, with net margins on new business over a fairly static ASX price falling by a couple of bucks over the course of the year. We also did one short-term deal in the middle of the year that compared favourably with the wholesale market counterfactual at the time, but did depress average pricing a touch. You'll see on the next slide that the net impact of all this was an improvement in the bottom line, but we are taking a reasonably cautious approach to further growth given the pressure on margins we're seeing. Our offer to customers has seen a fair amount of change across the year. Businesses are seeing a real need to respond to our environmental challenges, and at the same time, the tools to allow them to do that are becoming economically viable for more and more businesses. Neil has already mentioned the commercial solar deals we've recently done, and our analysis of individual customer usage, their patterns of usage, solar resource and energy and lines cost profiles has enabled us to start conversations with a good number of further prospects in this space. Through our own progress with electric vehicles, which now make up 50% of our passenger fleet and will be at 90% by 2020, we've seen how businesses can electrify and reduce end-to-end costs at the same time. We're working with a number of corporate customers to enable their conversion with the aim of further expanding the national EV fleet. Innovation in customer experience has also been a focus for PowerShop New Zealand, with the launch of the PowerShop Lite offering and the introduction of tenure-based rewards and a residential time of use product, Get Shifty. As I said before, we did see a lift in our retail segment results on last year, but prices and margins are under pressure. And in this environment, we have to be highly conscious of two things. One, the rapid evolution of customer expectations, and then the cost to service our customers. Whilst our cost to serve has reduced year on year, we'll need to do things differently if we want to make further progress. That's one of the reasons we made the decision to move all of our customers onto the Flux platform. We also want to be able to leverage the learnings we get across multiple geographies, which are at different stages of development for different market features. And we want all of our customers to benefit from the agility in terms of product development that our PowerShop customers benefit from in 3 countries. The shift does require extending the Flux platform into customer segments that are new to it, and we are not running this as a big bang waterfall project. Rather, this will be an incremental change over 2 to 3 years, which will cost around 30 million and is expected to reduce cash costs by between 10 and 15 million per annum post full implementation, as compared to our best alternative counterfactual. It's just worth touching on a few other stats relating to our customers, some of which are not that easy to interpret. First and easiest to be proud of, we've reduced our disconnection rate by 80% in the last 5 years, while at the same time reducing our bad debt losses dramatically. As an industry, it's incumbent on us to be on our game when we're dealing with our most vulnerable customers. Second thing to talk about is churn. The Meridian brand churn rate is the lowest amongst the major electricity retailers at the moment. We've been working hard on this, reducing all the friction points that irritate customers, but we're also fortunate to have a customer base that's significantly overrepresented in the conscious consumer category. We believe our genuine commitment to sustainability gives us an advantage here. PowerShop, on the other hand, has above-market churn, which looks oddly disconnected to their market-leading Net Promoter Score. But when you get under the covers of the numbers, the reason for this becomes clearer. Churn caused by moves is at roughly double the rate experienced by Meridian. Simply put, PowerShop has a more mobile demographic. No surprise it's overrepresented in the active and engaged customer group. Moving on to our New Zealand generation, so it's obvious from the charts that it was a low hydro generation year, well below our 15-year average. And this is despite total inflows being near average, and you can see why on the bottom chart, with 2 significant dry spells leading to a pullback in generation. And by the way, we also saw 6% lower wind generation than last year, with particularly low wind over summer when we needed it. But as we move into this year, things are looking a lot better. Inflows for July were 161% of average, and storage is looking pretty good at double the levels of the same time last year. So let's hope this and the recent run of high demand months continues. We'll be watching the pricing today. So whilst we saw physical generation down 6% on last year, the position of our portfolio, including the 1,000 plus gigawatt hours of NZAS back-to-back volumes, allowed us to both continue to grow our customer book and trade more volumes through the OTC and ASX markets. And we did this without additional exposure to high spot prices when it was dry. We also saw a higher average sales price on the smelters volumes, and whilst it's modest, an annual inflation adjustment on more than a third of our total contracted sales book is pretty welcome. We also benefited from 1 month in which the NZAS the NZ dollar price of aluminium got high enough to earn us a small additional price escalator. And I at this point, we mentioned, of course, this means that the smelter is generating quite a lot of positive cash flow in those circumstances. In fact, our external sources of aluminium industry data suggest they've also moved up into the 3rd quartile of the smelter cost curve, as they control costs better than some other global smelters. So with a reasonably positive exchange rate, an LME outlook based on the expectation that China's mandated summer curtailment will continue, we do expect the fourth pot line to be up and running in October. In Australia, as we reached a reasonably balanced VI position, we felt it was not sensible to drive further growth given the risks that would entail until we'd secured generation cover. This happened to coincide with a huge spike in wholesale prices that would have rendered that growth unprofitable in the short run in any case. So whilst we were not focused on driving acquisition hard, we've been pretty busy. We now have gas in market in Victoria. We also have a detailed map of market segments and a suite of products developed for those segments, including using the PowerShop New Zealand PowerShop Lite product to address less engaged customers, and using the white label capability we developed for the UK to partner with DC Power. Wholesale prices have started to come off somewhat, and the market has seen more of the wholesale prices rises pass through to consumers. So with the Green State acquisition and PPAs signed up, we're looking to use our gas offering and new products to start growing again. Australia still remains a very useful lab for new ideas, including our first foray into demand management, with the introduction of 2 products, Grid Impact, where we activate customer batteries during peak price periods, and Curb Your Power, where we provide power credits for usage reduction voluntarily during those peak periods. The Green State purchase was completed in March 18 for 168 million Australian. Now, all 3 of those schemes are run predominantly in the irrigation season, so it's spring to summer, so they align pretty well with peak electricity demand. Of course, water and its management are very different in Australia. As an illustration, the water released from Hume takes 6 weeks to arrive at its furthest irrigation customer in South Australia. Long droughts are also a feature in Australia, and this was factored into how much we were willing to pay for those assets. At the moment, New South Wales is experiencing a serious drought. However, storage at Hume Dam and the reservoirs above Hume, as well as at Burrinjuck Dam, are in reasonable shape. And so we're not expecting significant impacts to generation this financial year. Keep It will be impacted to a greater extent, but it's a lot smaller, so has a minimal effect on the portfolio. Of course, should rain not come, we'd expect greater impact in FY20. Our existing wind assets performed well in the year, with record generation that took advantage of strong wholesale prices. And we're now taking the first offtake of 10 megawatts from the Salt Creek PPA, which will ramp up to 20 megawatts from January 19. This is an interesting one. So Neil's mentioned the current turmoil in the UK market. This has brought some big challenges to our partner npower, including the interesting market feature of retailers currently putting prices into market at negative gross margins, so not even recouping the cost of energy, lines and metering, not making anything towards their operating costs. And for us, the flexibility of the Flux platform is proving useful in this environment, and PowerShop UK has, since the end of June, delinked its pricing from npower's and is opportunistically dipping in and out of regional markets as pricing windows open up, as opportunities to price and make money. This has led to sign-ups of more than 30% of the year-end customer numbers in the 6 weeks since the end of June. It'll be interesting to see how this turbulent market plays out, but our customer at the moment is happy with the performance of our product. Our current focus is on further adapting the onboarding journey to the UK market, including the introduction of a more innovative approach to smooth pay, which is a big feature of the market, and supporting the upcoming white label venture that's being planned, which will be relatively large. The merger with SSE presents both risks and opportunities to us, but on balance we see this as a positive thing given our record of rapid low-cost delivery. So turning to financial performance, I'll start by talking about dividends. Look, Neil's already discussed the interesting part of that, the forward capital management programme, so I'll just cover the reassuringly predictable part of the action. Our final ordinary dividend brings us to a full year payout of 14.32 cents per share, so that's 86% imputed and 87% of free cash flow, so an increase in ordinary dividend of 2.1% on the prior year. And of course, the next instalment of the capital management programme will bring distributions to 437.5 million since the programme began in August 2015. But as Neil's indicated, there's still a pretty good juice in the tank there. This next page, although this is a boring page that Owen insisted we had to include an IFRS 15. The long and short of this one is it doesn't make a lot of difference except to keep some accountants busy. And there'll be some more boring pages to come as we adopt IFRS 9 and 16 over the next couple of years. So I'll move on to earnings. As Neil said, it's good to see a 6th consecutive year of EBITDAF growth, admittedly small, despite 2 very dry periods in the year, so you can sort of do your own normalisation there. The big ticket items impacting this can be grouped between those things that were within our control and those were not. The big business changes included, firstly, the net impact of the expansion of fixed price sales enabled by the back-to-back contracts, both through retail channels and wholesale contracts, and that added net about 26 million to earnings. Then the impact of an indexation on the smelter contract, so that's an additional 18 million. Offsetting that, we had 5 million of net cost expansion. Now that supported the whole gamut of costs, including transmission, asset maintenance, retail growth, and expansion of Flux to service UK operations. I'll just go on to costs on the next slide. And finally, Australian earnings grew by a net $8 million. Then we moved to the slightly less in our control, and the 787 gigawatt hours lower physical generation effectively pulled our results back by $41 million. So with a bit of rounding, that all adds up to the 9 million change year on year. So moving on to one of the bits of detail behind the high-level results, and that's the movement on costs. Look, we have refurbishment and replacement works going on, as Neil said, at multiple asset sites in New Zealand, and these tend to shift between OPEX and CAPEX from year to year, depending on the profile of those projects. And this year, the two big ticket projects were heavily OPEX weighted, with the Oho chain refurbishment and the overhaul of the Te Apiti wind farm. And we expect those projects to hit peak spend this year, so we will see an impact in FY19. We also saw new costs in Australia associated with delivering our strategy there, in particularly in the cost of servicing a customer base of 100,000 throughout a full year. And then there's the back end of GSP maintenance costs, which isn't aligned with their spend. Their spend is obviously in the off season rather than when they're making money. We also saw costs associated with priming the Flux business for the Meridian migration project and expanding services into the UK. It was pleasing to see retail operating costs in New Zealand relatively flat despite the expansion in customer base. And offsetting the cost pressures, we had a 3 million reduction in transmission costs. Stay in business CAPEX fell well below the 65 million long-term average, and that in part reflects the shift of cash project costs into OPEX. So you really have to look at costs in terms of the overall cash bucket rather than OPEX CAPEX. The action below the EBITDAF line was pretty straightforward. Depreciation ticked up off the back of last year's generation asset revaluation. And I should note there's been no change in valuation booked at this year end because we really don't see any fundamental change in the underlying market conditions. Some minor impairments and land sales contributed a net positive 5 million. Tax was up 14 million, but did include stamp duty on the GSP acquisition of $10 million. So the effective tax rate in the accounts looks a bit weird, but it's got that stamp duty in it. And interest was up 4 million, given the increase in gearing across the year. All the other movement is in fair value accounting, with no cash impact, having a net negative impact on NPAT of 26 million. So have a look at page 51 of the results pack if that's the kind of thing that excites you. I'm not going to go through it. So at a net level, underlying NPAT was down on last year, reflecting the gain in EBITDAF offset by the increase in depreciation, tax and interest. And NPAT was actually up $1 million, reflecting these movements, plus the fact that we made asset sale gains compared to last year's impairments and losses. And I'll just finish by just quickly touching on debt and funding, mostly for the bankers in the audience. Our net debt at EBITDAF multiple is lifted to 2.3 times, not unexpected given the dry period and the continuing capital management programme. And I think you could probably sort of normalise that to see what the number would look like on a long-term basis. The tenor and sources of our debt remain well diversified, and that was aided by a successful 7-year fixed-rate bond issue we got away back in July. And our attention is now turning to the sort of 300 million plus of drawn debt and available facilities that we have maturing the next year. So I'll now just hand back to Neil, who'll give some final thoughts, followed by questions.
Yeah, just some closing comments. I guess the outlook for FY19 is good so far. Our the catchment storage is well above average, and we're already a long way through winter, so we're well positioned for the rest of the year. A strong national focus on climate action can only be good for the electricity sector. There seems to be growing consensus that the medium and longer term demand projections will be positive, and there seems to be growing consensus that adopting a renewable energy target is the more pragmatic way and will probably be more successful at reducing emissions than, say, targeting 100% renewable electricity. We'll know more about the electricity pricing review in September. and we're confident a good deal of consultation will take place before final recommendations are presented to government in early 2019. And in Australia, we think the NEG and ACCC recommendations, whether they get adopted or not, but if they were to be adopted, are likely to be positive for a net challenger brand like PowerShop on balance. And with our generation and wholesale position more secure, we're targeting renewed retail growth in that market. So I think that brings to a conclusion our presentation. We can now take some questions. And I think we'll start with questions from the floor. If you've got a question, we've got microphones here. Andrew.
Hi guys. So a few questions from me, and I know actually we talked a wee bit outside about this, but I guess just for the room as much as anything else. The target sort of net debt to EBITDAF metric, you would sort of talk to that a little bit going forward?
Yeah, I mean, if you look at what our competitors have said, I think Contact are talking about 2.8 and Mercury 2.2, was it? Somewhere around sort of 2.5, 2.6 feels like where S&P would start to get nervous if we lifted above that for long periods of time, for a long, sort of intentionally, if you like. I mean, I think sort of flipping above that the odd year would probably be okay. They give a little bit of credit to people who've got thermal plant. I'm not sure quite why, given that I see the same variation in their earnings, but it might be a conversation for later with those guys. But you can see there's still quite a lot of headroom. If you sort of normalise out the 2.3, you're probably at a sort of 2.1. Still a fair distance to run.
Next couple of questions, I guess, just related to OPEX. You talked about flux and moving everything to that, potentially doing $10 to $15 million relative to other alternatives. Are you able to give us a guide in terms of relative to FY18 OPEX? What sort of savings that would come out?
I think we'll probably come back with something once we've got a bit more clarity on exactly where that's going. So we'll come back to you later. I'm not going to quote a number off the top of my head. I do have a number in my head, but I just have to prove it up to myself first.
Okay. And just in terms of FY19 OPEX and CAPEX guidance, are you able to give us sort of any feel for that when you sort of talked about maintenance costs being high again? But
you got a little bit of a lift, I think, you'll be seeing.
Yeah, the OHAL programs are really getting going, and a lot of that expenditure is going to the OPEX line as opposed to CAPEX traditionally.
So you see, there's a little bit of a lift in that generation area, and then you'd expect if you see volume growth in Australia that, you know, obviously there are costs that follow that, and you will have a full year of those Green State costs as well.
In terms of the Te program, are you able to give us, does that complete in FY19? Because I know the generation's been down from that for a period of time.
Yeah, we've had a 18-month program. It got into the full swing earlier this year, so I think it'll be the back end of next year, calendar year, probably just post the end of the financial year that we'll have the bulk of that work done. But what we will expect to see is more and more turbines coming back online as we progress the work. But we are targeting something like a plus 90% availability at that site by the back end of next year.
And last question from me is just around the flux revenue, and I think on slide 49 you've got other revenue and miscellaneous going up nicely, which I think you talk about flux.
Yeah.
I presume that is that just the external flux revenue, so we're just looking at effectively the UK and some of the Australian.
Yeah, the rest of it's all eliminated out. So.
And it's fair to say that most of that increase is due to, in the last year or so, is due to the UK.
That's right. Yeah. I think there's an analysis of the other revenue at the back there, isn't there? Yeah, that's fully consolidated, that piece.
Thanks, Andrew. Anyone else from the floor? Nev?
Just a couple of questions. You mentioned in the annual report that you're looking at conversion discussions with heat loads across the country. Can you elaborate on sort of the kind of deals you might be talking about there and what kind of timeframes could come up there? And on sort of the outlook for consents for wind farms, to what extent do you think you might be incurring costs in the near term for reconsenting those or potentially seeking new consents?
Well, I'll answer the last question first. We are approaching council in respect to two of our wind farms to look at extensions and reconsenting. So we will be incurring some cost this coming financial year, or the two FY19, possibly into FY20. But we don't anticipate that they're significant at this stage, Nev. And the first question?
Conversion of industrial heat. Hey, it's slow going. I mean, you know who the big boys are in this, and it's the dairy industry. And you would have seen Fonterra's most recent announcements, which were really around the lowest hanging fruit, which are effectively converting some of their steam processes through to electricity. Relatively minor in terms of effect. I think for them to bite off the full cherry, as it were, there'll need to be greater incentive and pressure on them to do that, because from a straight financial perspective, it's quite hard to make the equation work with a price which would look attractive to us or our competitors.
One of the big impediments is the increase in transmission costs under the current transmission pricing regime when you convert a boiler to electric, and at those reasonably rural facilities. So
That just raised one other question too, or in fact two, I have to confess. One of them is the impact on these recent solar deals, construction ownership, construction sale. How are those affected potentially by changes in distribution pricing? Are you sort of inoculated against changes there?
We're dealing with customers that are typically got reasonably sharp rates and reasonably sharp distribution pricing already. So we think that potential changes in the distribution pricing are relatively benign in respect to the customers and the relationships that we've got, or those particular facilities.
We're insulated from those under the contractual arrangements, though. So provided the customer is creditworthy, the deal is not impacted by change in those regimes.
Yeah, not from Meridian, and we think there's the customers are relatively immune from potential change.
And unrelated, but it just occurred to me, the growth plans for Australia for PowerShop. So I think you spoke in the investor day about doubling the size there. Any kind of idea on the rates for that, and is doubling still the target?
Yeah, doubling's still the target, probably over a 4 or 5 year time frame. But we would like to see a sizable lift in customer numbers this coming year. So talking, circa 20,000. But we want it to be a gradual and consistent growth profile, because we think that's going to deliver the best long-term outcome.
We know there are large chunks of market that we just don't address at the moment. So there are plenty of places to go.
Just coming back to wind, Neil, I take it that the sites you're looking to get new consents on will be Central Wind and Mangahururu. If not, maybe you could expand on that. And really keen to understand whether Meridian really wants to be the next builder of the next wind farm in New Zealand, or are the options getting so wide out there that you don't necessarily need to be the builder of your own assets? The two wind farms that we are working on specifically for extension and change are Central Wind and Mangahururu. In terms of whether we want to be the next builder of a new wind farm, well, we think we've got the best option on the books. We think the Mangahururu wind farm looks pretty attractive and compelling, so we think it's well up there in the merit order. When we'd like to build it will depend on the supply-demand mix, and it's not called for just yet. So we're not making that decision, and probably wouldn't be looking to make that decision for at least another year. Just following on from that, can you give us a flavour as to the sort of consent changes you're seeking? I imagine you're looking at bigger towers and bigger rotors, and how useful do you anticipate any issues getting those consent changes?
Look, we're looking at whether we can incorporate a larger diameter within the current tip heights. We're also looking to if there's options to increase tip heights, which would improve the efficiency of the whole wind farm. The studies that we've done to date would suggest that any changes along those lines are minor from an environmental impact, negligible. So we're not anticipating a massive problem with getting those particular consent changes through, but we still need to work it through with all the stakeholders to ensure that everyone's well briefed and we've got support. Right, if there's no more questions from the floor, we'll go to the audio bridge.
Thank you. If you wish to ask a question at this time, please press 01 on your telephone keypad and wait for your name to be announced. We'll now pause a moment to assemble a queue.
Who's first?
Once again, if you wish to ask a question, please press 01 on your telephone keypad and wait for your name to be announced. Your first question comes from the line of Grant Sapolu from Craig's Investment Partners. Your line.
That one before. Not too bad, actually. First question, just on something, I don't know if you had a quick browse at Mercury's results yesterday. They just put an interesting slide in there regarding to wholesale prices over 2017 and 2018, and when they were at similar dam levels. The wholesale prices over 18 were showing a $15 to $20 uplift on 17, indicating a tighter supply-demand potentially. But you guys are talking about a similar environment that you're seeing last year to this year, and also the forward hedge curve has fallen off. Sorry for rambling on. I just want to know your thoughts on why the hedge curve isn't rising, why you don't think that is reflective, the higher wholesale prices isn't reflective of a tighter market and actually closing in on a new build nearer than people are thinking.
The similar environment comment was mentioned in relation to revaluation, I think, which is really just because our valuation is largely multiples based. There's a similar environment from a multiples perspective. But yeah, I mean that slide is a very interesting one, and we have seen some of that effect. But as you say, it not making its way through the hedge market is a bit mysterious to us at the moment. I mean, honestly, we think that there has been a tightening of the supply-demand balance, and we've seen some pretty big months from a demand perspective in the last few months, and none of it seems to have shifted that forward curve much. So maybe a delayed reaction, maybe anticipation of future builds. Who knows? It's just how the market is expressing itself. But in the meantime, when that squeeze does occur in the wholesale market and we've got water as we do at the moment, then it's a good thing for it.
Yeah, I think, just to reiterate, I mean, it's more recent months that we've seen what we think is a sign that demand is shifting. But the market is the market, and there's lots of players out there, including more than just ourselves and Mercury, participating in it, and it's discovering a price that seems to be comfortable with. So interesting to see how it tracks from here.
Paul, can I get back to you again? Just on Powership Australia, we were anticipating a slightly quicker pickup in those numbers, and as you point out, it's now a 5-year program to double. Is that due to the new entrant or the Chinese entrant that's hoovering up, I think up to 1 million customers already, that's causing a bit of headwind there? And will you find yourself a little bit long generation in the near term because of the slow pickup in the retail book, and is that a positive thing? Thanks.
So start with the back end. Yeah, we will find ourselves long generation in the shorter term, and yes, in the current price environment, that looks like a positive thing because, I mean, our expectation is to see the LGC price drop away sort of 2020 and beyond. But this coming year, you know, that's a positive thing, and wholesale prices are still relatively high. So, and the PPAs will be in the money over that period. With the sort of static position that you've seen over the last sort of quarter or so, or over the last year, and the fact that we didn't pick up, it's just simply a function of where margins were at, and the fact that prices only change in Australia once a year, effectively. The market sort of tradition is for prices to change in, I think New South Wales is June and Victoria is December. So we've just recently seen all the price changes move through in New South Wales, which pushed us from being in quite a non-competitive position, and it was good we were holding steady in that position, to being a lot more competitive because a number of people shifted price, and more of that wholesale market change was passed on to their customers. So we've got a slightly different pricing dynamic. It'll take a while in Victoria to get to that because we are sort of still living with prices from last year. And yeah, the Chinese, that's part of the challenge we've got. They have been hoovering up, particularly in Queensland, interestingly. So they have been hoovering up a lot of customers. And they've been putting prices into the market which look pretty much unsustainable, but they're taking a long-term position. But as I said, there are whole swathes of the market that we haven't yet addressed. And there are swathes of that market that haven't been addressed that include the sort of consumer that we target.
Thanks.
Your next question comes from the line of Aaron Abbottson. Your line is now open. Please go ahead.
Hi there. Good afternoon. I just had two, I'm afraid, quite similar questions. But firstly, on the wind development that you talked to quite a bit, I was just curious, you mentioned that you don't think you're going to make a decision until at least a year from now. So what are the key indicators that you're looking for? Is it purely a demand base, so if we see another % growth? Or has it to do with future pricing, or is it both? What sort of are the key input variables for the board when to call it, or is it how the consent discussions are going? And secondly, and apologies if I have misunderstood this, but I just wanted to understand a little bit better what impact you're expecting in Australia from this GSP acquisition. For some reason, I had slightly higher numbers coming through already this year, and I wanted to know if you could talk to a little bit, and I know it's volatile in Australia, but sort of what you're expecting for FY19 in Australia, and maybe if there is a seasonality there between the second and first half that's quite strong, which is going to repeat. Thank you.
I'll answer the first question. You take the second one.
Yeah.
So I think it's all of those things, Aaron, in terms of the decision to build another wind farm. We will be looking for evidence that demand has lifted. We've seen some this year, but I don't think if we had another wind farm deployed in New Zealand right now that the system needs it. It's factors like cost, the exchange rate comes into play. So we want to do this as efficiently as possible and at as low a cost as possible. And then we are working through those consent issues, and we're trying to do that in a way that we don't rush it, because there are other stakeholders that need to be involved and brought along for the journey. So we're just thinking that at this stage, as we work through those various issues and as we get a bit more of a firmer view as to how we think the future demand situation might play out, a decision sort of late next year could be on the cards. At the same time, that decision might be to delay for another year. So, but it's all those factors that we're taking into account. I'm not in a hurry to get one through the board right at the moment, because, like I say, I don't think the market needs it.
I'm desperately scratching around in the financial statements at the moment, because there's actually a number in there, and I don't want to give you a number that's not in line with that. Aaron, if you look in the financial statements, there's a piece on the acquisition which says what the impact would have been had we owned it for the full year for FY18. So you can actually see those numbers. Where is it? So it's actually specified in there, and so I'd look at that rather than me quote a number off the top of my head. And then, because I just want to go back and check what we've already put into the public domain on that thing. Yeah. Can I point you at that, please? And Owen and I will have a look and see if we need to put something else out that gives a bit more colour to people around those numbers.
Thank you.
There are no further questions at this time.
Okay, well, with that, we'll wrap it up. Thank you all for attending, and have a great rest of the day. Thank you very much. Cheers.